Hi everybody, welcome back to Ox Talks. It is Monday, January the 8th, 2024. Hope you're having a good start to your work week. Hope you're having a productive day today. Appreciate you all being here, watching these videos. I ask that you please subscribe to the channel if you haven't already done so. If you have subscribed, thank you for supporting my work and these videos. Let's please continue to share this material with family, friends, coworkers, colleagues, anybody who expresses an open mind to actually wanting to hear about what's happening in the economy, with the consumer, and with current events as a whole. Again, thank you very much for supporting the channel. Please don't forget to hit the like button and the bell notification as well. Today in the practice, actually this week, I'm working on a fairly substantial project. I represent the plaintiff in a case. It's a defamation, invasion of privacy matter, and we've received by the opposing side a motion for summary judgment, and that's where a side in the case is asking for the court to enter judgment based upon the evidence prior to trial. And the burden of proof, or the standard, is very high for a moving party in a motion for summary judgment. Lawyers call it an MSJ. What the moving party has to show is that there is no triable issue of material fact as to any claim raised in the complaint, or as to a defense pled to the complaint. There's also an alternative motion for summary adjudication where you're asking the court alternatively to simply decide that for maybe one or more causes of action that there's no triable issue of fact for a judge or a jury at trial, and therefore a judgment should be rendered on law and motion basis before trial. So it's a case dispositive motion. If I'm not successful in opposing the motion, the case stops there. It's never going to get to trial. But the burden of proof, again, for a moving party on the motion is pretty high because they have to show no triable issue of fact, and usually the evidence does support a triable issue in most circumstances. In this case in particular, it's going to be a battle of forensic experts, accountants, because we have a very complex accounting issue where there's been some allegation, in this case, of embezzlement. And so the forensic accountants are going to be submitting battling declarations and evidence and deposition transcripts to fight this thing out. Obviously, I have to pull it all together, draft declarations, work with the forensic CPAs, take the depositions, gather all the evidence. It's a very, very, very time-intensive process. MSJs, probably, in addition to depositions, are the most time-intensive portion of a litigation case other than the trial itself. So thought you guys might find that interesting. I'll keep you posted on how it goes. My opposition to the motion is not due until late February, but we have to put all these chips in place, get all these things underway, working with the expert witnesses now, because the time goes fast. Let's talk about a couple of articles I read today that I think are really important to share with all of you relative to this consumer economy, this debt-ridden economy. And we did some shows back during the holidays about consumer spending and the malls, and whether the people that were out lining up at the malls were actually paying cash for the things they were buying, or were they deficit spending? Were they putting these things on credit cards or lines of credit or things of that nature? Also, we did a show on the buy now, pay later plans, which basically is a debt scam as well. So numbers are out from Zero Hedge today. This was posted today, just a few hours ago. It says consumer credit shocker. November debt soars after second biggest surge in credit card debt on record. It says, we and many others were wondering how it was possible that U.S. consumers, already tapped out beyond a breaking point, with collapsing savings and declining real wages, we're able to push holiday spending, which started in November and continued until the end of the year, to record nominal highs. It says, now we know, according to the latest monthly consumer credit report from the Fed in November, consumer credit exploded higher, listen to this, by $24.75 billion. That's with a B, blowing away expectations of a modest $9 billion increase. So the expectations were for $9 billion increase on the debt, and it was $24.75 billion. By my calculation, that's almost a 300% or a 3x miss by the so-called economists and expectations. This is after surprisingly subdued $5.8 billion in October, which was revised upward from $5.1 billion and $4.3 billion average for the past 6 months. So it's been averaging $4.3 billion for the past 6 months. Now we know during the holiday season it went up to $24.75 billion, which is 8 times. That's 8 times. Well, no, it's 7 times. 7-fold in consumer spending during the holiday season. Says this was the biggest monthly increase since last November and was the first $20 billion print since January of 2023. When looking into the details, we find something remarkable. While non-revolving credit rose a modest $4.6 billion, and here we go, here's the kicker. What was the big shock in today's data was the blowout surge in revolving credit, which in November exploded by a whopping $19.133 billion, a record surge from the $2.9 billion in October. And here we go, the second biggest monthly increase in credit card debt on record. So what have people learned? They have learned absolutely nothing. Now, is there a fair percentage of those people that use the credit card to get the benefits of the card for convenience of maybe not having to use cash and then paying off those credit cards immediately without having any rollover or revolving amount or interest? Sure there is. But the vast majority are people spending money they don't have. This despite the average interest rate on credit card accounts in quarter 4 flat at a record 22.75% for the second quarter in a row. So these people are swiping credit cards. They're paying 22, almost 23% interest on that holiday spending now. Those credit card bills are going to be coming in the mail this month. If the first ones are not already here, you've got interest charges at almost 23% before you even touch the principal balance of what you spent on that card. This is what is especially surprising about this confirmation that the bulk of holiday spending was on credit, is that it takes place after several months of relative return to normalcy, when consumers appeared increasingly reluctant to max out their credit cards due to record high rates, and at a time when the personal savings rate in the United States had collapsed back to multi-decade lows in recent months. And I think the conclusion is appropriate. It certainly is in keeping with the theme that I try to constantly express on this channel when we talk about the government spending and the government deficit spending and the government debt that's being run up now more than $34 trillion. The article concludes by saying, well, it now appears that Americans have once again done what they do so well, follow in the footsteps of their government and throw all caution to the wind, charging everything they can and whatever they can't, put on installment plans, which also hit a record late last year, including groceries on their credit cards, and praying for the best or not even bothering to worry about what comes next. We did a show a couple weeks ago on doom spending and that 27-year-old financial advisor from TikTok that was telling everybody, live for today, don't worry about it, the world might come to an end. So that is the up-to-date daily data on what the consumers did over the holidays with abusing their credit cards. So I don't know. I mean, the government hasn't learned any lessons, but the government has a printing press, so they can just keep creating more imaginary digits on a screen to finance the deficits, selling more bonds. What can the consumers do? They can't do anything. They're going to pay this credit card debt off.
It's going to sit there and accumulate interest. If they default on the credit card debt, they're going to get sued by the credit card companies. Their credit's going to go down the toilet, and eventually they're going to end up in bankruptcy court. So is that the game plan? I don't know. The point is this. If you are one of those people, I'm not sitting here lecturing anybody, but it might come across that way. Maybe it is a bit of a lecture. If you're one of those people who is who's living paycheck to paycheck, to pay for basic necessities, yet you went out with a new Visa card or whatever credit card of your choice you carry and ran that thing up over the holidays to buy a bunch of gifts for people to show up to the holiday party with, and now you're dealing with that increased load of debt. I don't have any sympathy for you. I don't feel sorry for you. Your spending habits, your habits in general, are going to end in financial catastrophe. So to those people, you had better wake up to what's going on and change course with the spending habits. I'll move on to the next article I saw, which talks, it's from also Zero Hedge Today, actually came out, this morning. It says inflation expectations tumble to the lowest since January of 2021, as do wage and spending growth in the latest New York Fed survey. So hear what that article says, or the title says, and I'll get into a few details. Inflation expectations tumble, but also wage and spending growth. So wages expectations are coming down just as inflation is. And inflation, I'll read you the stats, is not coming down to keep up with how fast wages are slowing. So again, the consumers are going to continue to feel pinched and crunched by what's happening. This is after a few months of late summer increases in the first year inflation expectation, as tracked by the New York Fed's monthly consumer survey. December saw the third consecutive decline in this series, which traditionally is also a proxy for the price of oil, and which last month dropped to the lowest since January 2021. Oil got clobbered again today, shorted pretty heavily. Very, very strange. I'm off topic here, but very strange that that's happening when you have the Red Sea crisis unfolding. You have a vast majority of the world's shipping containers having to take a longer route, adding 1 to 3 weeks to their journey, adding the necessity for more oil, adding delays for oil shipments through that area, yet oil is getting pounded down. Anyway, makes you question. So this says, while that would be great news, meaning the reduction in inflation expectations, in isolation it wasn't, because as the New York Fed also found, the disinflation data is actually the bad kind. Since the December survey found that earnings growth and spending growth expectations also decreased to their lowest recorded levels since 2021. Inflation expectations at the one-year horizon decreased to 3.01%. Mark that number. 3.01% is the expected decreased inflation number, and that's down from 3.36% in November. But here's the issue. And the median home price growth expectations, it said, remain unchanged at 3%, remaining well above the series 12-month trailing average of 2.4%. So the median home price growth is holding at 3%, up from 2.4%. Here's the issue. The bigger problem for the Fed is that while overall inflation expectations dipped, it wasn't for good reasons. Indeed, the expected year-ahead earnings growth fell to the lowest level since April 2021, as median expected growth in household income decreased by 0.1 percentage point to 3.0%. The decline was driven by respondents with a high school diploma or less. The New York Fed said people earning less than $50,000 a year expect a 1% income growth, while those earning $100,000 or more expect a 3% growth. The series has been moving within the narrow range of 2.9 to 3.3 since January of this year. So inflation expectations are 3.01, a wage growth is 3.0. You're still losing purchasing power. Your money still is not keeping up with the pace of inflation and the expected wage growth in this country. So how are the consumers ever expected to get ahead if the wage growth is not exceeding the pace of inflation? It's not going to happen. So you might want to think about some inflation hedges in your portfolio. some hard assets. We've discussed that before on this channel. We're right about 15 minutes now. I hope you got something out of today's video. I'll be leaving here in about an hour to get my Monday afternoon workout in. We talk about the physical fitness. I'm back on my regimen, started yesterday morning, getting my gallon of water in a day, keeping hydration levels high, going to cut out some of the excess, just stuff that started to sneak its way into the diet over the holiday season. No big deal. It's not a sacrifice. You just do it. It's just little stuff that shouldn't change your overall mood or your overall approach to anything at any given day. Making some small changes can go a long way, but it is primarily diet driven. So watch what you put into your mouth, folks. Get your exercise in. Start working in some strength training. With that being said, hope all of you have a great evening tonight. Thank you for supporting the channel. I'll see all of you tomorrow. Bye.